Have you ever heard someone say this mutual fund has low NAV so it's cheaper? Or this fund's NAV is too high, I have missed the opportunity? In this video, we will break down one big myth and explain what NAV really means in mutual funds in the simplest way possible. NAV stands for net asset value. Simply put, NAV is the price of one unit of a mutual fund. It is the price at which you buy mutual fund units and the price at which you sell them back. If you invest Rs 5,000 in a fund with NAV Rs 100, you will get 50 units. If you redeem later, you sell those units at the NAV of that day. Think of a mutual fund like a pizza shared by 10 friends. If a pizza costs Rs 1,000 and 10 people contribute equally, each person owns Rs 100 worth. NAV is simply the value of one person's share. More people, more money, bigger pizza. But everyone's share is always calculated fairly. A mutual fund owns stocks, bonds, cash and other investments. NAV reflects the total value of everything the fund owns minus what it owes divided by the total number of units. So NAV not a guess, it's a calculation based on real market prices. At the end of every trading day, the fund house does four things. Number 1, it checks the closing price of all stocks and bonds. Number 2, it adds up the total value of all investments. Number 3, it subtracts expenses and liabilities. Number 4, it divides the remaining value by total units. The result is the NAV for that day. NAV changes every single day. Why? Because stock prices change, bond prices change, interest is earned, dividends are received, and expenses are deducted. When markets go up, NAV go up. When markets fall, NAV falls. This is completely normal. NAV is calculated only once a day. It is not live like a share price. After markets close at 3:30 p.m., NAV is calculated and published by night. So everyone investing that day gets the same NAV. Now let's bust the biggest myth. Low NAV does not mean the fund is cheap. High NAV does not mean the fund is expensive. NAV is just a number. What matters is percentage growth, not the NAV value. If you invest Rs 10,000 in a fund with NAV Rs 10, you will get 1,000 units. If you invest Rs 10,000 in a fund with NAV Rs 100, you will get 100 units. If both the funds grow by 20%, both investments become Rs 12,000. Different NAVs, same returns. Another common myth is NFO at Rs 10 is a bargain. The Rs 10 NAV in an NFO is just a starting number. It does not mean safety. It does not mean cheap. In fact, an NFO has no track record, so it is not automatically better than an existing fund. A higher NAV does not mean better performance. It usually means the fund is older or has grown over time. Performance should be judged by returns, consistency, and comparison with the benchmarks, not its NAV. NAV is the price per unit of a mutual fund. Market price applies only to ETFs and closed-ended funds. Your fund value is simply number of units multiplied by the NAV. Don't mix these three, they are different concepts. For lump sum investments, NAV does not decide returns, growth does. Whether you invest at NAV 50 or Rs 100, if growth is there, returns will be the same. In SIP, NAV actually works in your favor. When NAV is low, you buy more units. When NAV is high, you buy fewer units. Over time, this averages your cost. This is why SIP is so powerful for long-term investors. Instead of NAV, focus on these 5 things. 1. Long-term performance. 2. Performance versus benchmark. 3. Expense ratio. 4. Fund manager track record. 5. risk, and consistency across market cycles. NAV is just a price tag. NAV changes daily because markets change. Low NAV does not mean cheap, high NAV does not mean expensive. Your wealth grows from discipline and long term investing, not NAV numbers. This was part of our Mutual Funds Made Simple series. At WealthRise Investments, our goal is simple: helping investors understand money clearly so they can invest with confidence. Follow WealthRise Investments for more simple, no confusion investing education.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully before investing.